Welcome back to the deep dive. Look, if you're trying to keep up with DePIN, that's Decentralized Physical Infrastructure Networks, it's a challenge, right? Trying to figure out which projects are solid, which have legs. XYO is one that often comes up. They've actually been around since 2018, which, is a long time in this space. And they have this huge network, over 10 million active nodes, they say. So our mission today, specifically for you listening, is to cut through some noise. There's been a big shift with XYO recently. They launched their own layer 1 blockchain, and there's a whole new staking model. We want to really break down this new dual token system, explain what you actually earn, and crucially lay out the exact steps for how you participate now. Because honestly, our sources show there's been quite a bit of confusion about staking, especially in the past.
Yeah, and what's interesting is XYO wasn't just jumping on a bandwagon. They kind of pioneered this whole decentralized data verification thing early on. Their whole innovation was built around their own tech, like Proof of Location and Proof of Origin, stuff that's really vital for, say, logistics or tracking assets securely. This new layer 1, the one they just launched in 2025, it isn't just another general chain. It's specific. It's built for heavy data loads. Think high throughput DePIN, think AI training data, real-world asset projects, things that need really solid, verified location data. And maybe just quickly on those terms, proof of location that verifies a piece of data came from a specific place at a specific time. And proof of origin, that basically ensures the data hasn't been messed with since it was created. It tracks its history. Putting those right into the layer 1, it means data security isn't just an add-on. It's like fundamental to how the network agrees on things.
Right. And this focus, this enterprise-grade data focus, it's not just talk. The market seems to notice me the 6YOG token, it's on Coinbase, Kraken, KuCoin, Bitpanda, major exchanges. And they even reported, $8.8 million in revenue for 2024 in an SEC filing. That kind of financial reporting, that legitimacy, it really puts them in a different league compared to a lot of, typical crypto launches just starting out. Okay, so let's really get into the engine driving this new layer 1, the dual token model. This seems to be the core piece that tries to solve that old problem in blockchain, separating the long-term value, the governance from the everyday cost of actually using the network.
Exactly. That separation is, it's pretty key for stability in the long run. If your governance token is also your gas token and its price goes wild, it makes using the network unpredictable, potentially expensive. So splitting them gives you two tokens working together, but with really distinct jobs. So token 1 is XYLers. That's the original one. Think of it as the governance token, the long-term value anchor. It's got a fixed supply, 13.93 billion tokens. That's it. Its main jobs. Staking, governance votes, securing the ecosystem's growth. And when you stake it, when you lock it up, you're taking it out of circulation. That encourages holding it long term. Then you have token 2. XL1. This is the network's fuel, the utility token. It's used only for paying gas fees, processing transactions on the layer 1, and rewarding the node operators keeping the network running. It handles all that high-frequency, day-to-day stuff.
Okay, that sounds logical, but let me push back a bit here because some might see this as, overly complex. If staking XYL, the fixed supply one, is the only way you can earn $6 on one, doesn't that tie their values together anyway? How separate are they really? And does that connection maybe undermine the stability argument for the dual model?
That's a really fair question. It gets right to the core of the design, actually. Yes, the staking mechanism creates a link you need, XYL, to get the utility token, $6, so there's a demand relationship. But the economic levers controlling them are separate. XYL's value is underpinned by its fixed supply and governance power. $6 stability, though, that's managed by its specific use case gas and, importantly, built-in deflationary aspects. Like, when you pay gas fees in $6, a part of that fee, the base fee, it gets burned, destroyed, gone forever. This constant burning helps keep the $6 supply balanced, hopefully more stable, even if the XYO governance token price swings around a lot. So yeah, you need one to earn the other, but their supply controls and value propositions are designed to be different.
Okay, that clarifies the deflationary bit, the burn mechanism. That helps. So it connects long-term holders to the network's actual use, but still tries to protect the core asset scarcity. Makes sense. So if that's the why behind the model, let's dive into the how. Practically speaking, how does staking work on this new layer 1? How do people actually generate those XL dollar rewards?
Right, so the process itself is built around delegation and securing the network. When you stake your XYOers, you're essentially delegating those tokens to validator nodes. These validators are the ones doing the heavy lifting, validating transactions, proposing new blocks, finalizing them on the layer 1 chain. And when a new block gets successfully produced, that's when new XL dollar rewards are generated and paid out. These rewards come from something called the step step reward pool. You can think of it like a dedicated treasury. It's filled with newly created SexL dollars specifically set aside for rewarding stakers. This ensures there's always SexL dollar available for rewards. And importantly, you don't actually need to run a validator node yourself, which can be technically demanding. You can do what's called system staking. It's basically nodeless staking. You still lock your XYO, you still earn SexL dollars, just maybe at a slightly lower rate than the full validators who cover the server costs and uptime requirements.
That clarification on the step reward pool is helpful knowing where the XL1 actually originates. And you mentioned incentives. The system seems designed to really encourage getting involved early. The sources pointed out that early stakers get higher XL1 emission rates, and these rates are set to decrease over time.
Oh, absolutely. That's a very deliberate design choice. It's meant to bootstrap network security quickly by attracting stakers early on. But security isn't just about dangling rewards, right? It's also about consequences. The system includes economic penalties, specifically slashing. Slashing is it's a critical part of maintaining integrity. If a validator node or the people who delegated to it misbehaves, maybe they try to double sign a transaction or they just go offline too often, they get penalized. A portion of their stakes XYO gets slashed, basically taken away. And those slash tokens, they get put back into the reward pool. So it directly benefits the honest participants who are doing things right. It really aligns everyone's incentives towards keeping the network secure and reliable.
Right. Consequences. That makes sense for security. Now, circling back to something we touched on earlier, the confusion. We saw lots of chatter, people asking, why can't I stake on Coinbase? Or trying old methods that didn't work anymore. It was clearly a bit of a headache for holders for a while there.
Yeah, that confusion was totally understandable because XYO didn't start on its own chain, right? It was originally an Ethereum token, an ERC20. So people held it on exchanges expecting maybe a simple stake button like they see for other assets. But those older ways, like trying to use exchange vaults or whatever features existed before, they're obsolete now for this purpose. To participate in the new Layer 1 staking, you have to physically move your XYO tokens off the exchanges and onto the actual XYO Layer 1 blockchain. And doing that means engaging with Web3. You need a self-custodial wallet, one that can interact with the XYO Layer 1. This is really key for control and security. You need a wallet where you hold the private keys and one that explicitly supports XYO L1 staking. This way, you control your funds, you control the staking duration, you receive the rewards directly, no intermediary exchange is managing it for you.
Okay, so let's make this super clear for anyone listening who's been confused or wants to get started now post L1 launch. Here are the straightforward current steps. This should cut through that old complexity. Step 1, get the XYO token. Simple enough. You buy it on a support exchange, Coinbase, Kraken, KuCoin, Bitpanda, those major ones. Step 2, move to your own wallet. Withdraw this XYO lure from the exchange to a self-custodial wallet that supports the XYO Layer 1. Step 3, connect to the portal. Use that wallet's browser function to go to the official XYO Layer 1 staking portal. That specific interface. And step 4, stake it. Choose how much XYO you want to commit, maybe select a staking duration if options are offered, and then authorize the transaction through your wallet. Once that confirms on the blockchain, that's it. You're staking, you're helping secure the network, and you should start earning those XYO dollar utility tokens.
And connecting this back to the bigger strategy, this whole move to their own Layer 1, it wasn't just, a tech upgrade for the sake of it. It feels like it was driven by economics and use case needs. These really data-intensive applications, DePIN, complex AI, RWAs, they need verified, real-world data, processed super fast with low latency. High throughput is key. Trying to shove all that verification traffic onto a general-purpose chain like Ethereum, which can get congested and expensive, well, it was likely never going to cut it for serious enterprise adoption. XYO essentially needed its own dedicated highway for its specific kind of data traffic.
Yeah, let's make that concrete with a couple of examples for you. Imagine a big e-commerce company. They could offer a premium service, say payment upon delivery, using smart contracts. The XYO Network's Proof of Location could verify that the package physically arrived at the exact GPS coordinates at the right time. Only then does the smart contract automatically release the payment. No need for manual checks or trusting centralized logs.
Or think about autonomous drones, maybe for deliveries or monitoring. The future airspace could be crowded. You'd need a shared, trusted, decentralized way for these drones to report their precise location accurately and provably so they don't collide. XYO's proof of origin could track that data immutably on their Layer 1. Regulators, manufacturers, they could trust that location trail instantly because it's cryptographically secured right from the source.
That definitely paints the picture of why this kind of dedicated infrastructure might be necessary. That's the optimistic view, but we always need to temper that with a realistic look at the risks. Right, especially considering you're locking up XYOLers, which is supposed to be the scarce governance asset. How much does the potential XL dollar reward need to compensate for the risk of having your main asset locked up and illiquid?
That's probably the number one risk stakers need to understand. Token lockup. Depending on the staking terms you choose, that XYO could be completely inaccessible for a set period. You are absolutely trading liquidity today for potential rewards tomorrow. That's the deal. And beyond that lockup, there are other key risks to weigh. First is just plain market volatility. You're earning rewards in XL1 dollars, but your principal is XYO. The actual dollar value of your return depends on the price movements of both tokens, which can fluctuate. Second, there's always technical risk. Smart contracts can have bugs or vulnerabilities, even though systems like this are usually audited. It's never zero risk. And finally, there's the reward reduction aspect we mentioned. Those XL1 Believer missions are designed to decrease over time. So the yield you get initially won't necessarily be the yield you get years down the line. Early participation is incentivized for a reason.
Okay, so wrapping this up, what's the main takeaway here? It seems XYO's new setup is a serious attempt to solve that scaling and value separation puzzle. They've clearly separated the fixed supply, potentially appreciating governance asset, XYOlers, from the operational utility token, XL dollars, which pays for network usage.
Exactly. And the final point for you, the listener, is really about participation. Staking XYOvers isn't just about trying to earn some passive yield. It's a direct way you can contribute to securing this specialized data network. You're funding the creation of the utility tokens needed for it to run, and you potentially get a say in its future governance. You're aligning yourself with the growth of this specific type of decentralized infrastructure, which leaves us with a really interesting question to think about, especially as DePIN grows. Think about huge, established centralized systems, FedEx, Amazon Logistics. They operate with incredibly high reliability, near perfect uptime. XYO's whole model relies on its massive but decentralized network of over 10 million nodes staying reliable. So the big question is, will the economic incentives of staking XYO orders, earning XL dollars, and the threat of being slashed, will that be strong enough to ensure this decentralized network achieves the kind of rock-solid 99.99% uptime and data accuracy that large enterprises absolutely demand for critical logistics or AI applications? That's something the market will be watching closely.